Welcome to the late summer edition of the Family Firm's review of the economic and investment landscape. I hope wherever you are, you've had a great summer and enjoying the same sort of glorious weather we've had recently in this area. Let's add this to the list of unusual events of 2024, low humidity in DC. But for today's call, my plans is to think about the next 9 to 12 months and try to itemize the major issues we should be concerned about. And then I'll attempt to assess how much we have to worry about or look forward to from each. Now, I'm even going to be very brave and attempt to rank these in order of importance from the most relevant in this time frame to the least. So the one I think is the most relevant for what will be happening with our investments is inflation. We all felt the dreadful impacts of that in 2022, and now know for sure how it can decimate our stocks and bonds. And now we've enjoyed this period of moderating inflation, which has fallen from a peak of around 9% to its more moderate 3% today. And although this is above the Fed's stated target of 2%, it seems fairly clear they're okay with this level, for now at least. But the question is, I guess, should we worry about a resurgence of inflation? And to try to answer that, I looked back at what caused the inflationary spike a few years ago and kind of see, could those repeat themselves? So what we had, bring up some bad memories, the pent-up demand from COVID met huge federal spending levels, met 0% interest rates, and a Federal Reserve that was sound asleep. And then we added to that commodity price shock from Russia's attack on Ukraine and the supply chain snafus that popped up. So when I look at all of those, I'd say outside of the ongoing generosity of the federal government, none of those conditions hold today. And what's also encouraging about today's situation is that the inflation from a couple of years ago didn't generate any wage price spiral. Yes, wages rose, several unions scored some big wins, but the kind of wage price spiral that we saw in the 70s did not occur. So a fairly benign outlook, I would argue, for inflation. Is there any risks? Are there risks? Probably the biggest is still some sort of disruption in energy supply. That's a cause for concern always, but overall, not nearly enough to cloud the generally positive story from inflation. So how about recession? And I have to say about this, the stock market went down for a couple of weeks. It had one bad day, a couple of bad weeks. And all of a sudden, the only word we could hear about was recession. The fact is, it's just not there. Unemployment is low, albeit a bit higher than the full employment economy of early this year. Corporate profits are sky high. Spending is fine. Consumer spending is fine. Household and corporate debt are very manageable. Things are fine. Perhaps, the worry here, if we're looking for one, could be a spillover from some, shock global event. Even, for instance, a real collapse in the Chinese economy or some kind of global war. But, overall, when we're looking out over the next 9 to 12 months, there's little cause for concern for a recession. So my next one on my list is the election. And notice how I didn't have this as number 1 or 2. You're welcome. I know this is a little risky to say, but really the markets seem to be viewing the election as kind of a neutral event so far. And why am I saying that? Well, throughout these turbulent few months, and we'll talk about those, where the election prospects have seesawed so dramatically, the market has been basically unfazed. Republicans ascendant, we had a debate, we had, assassination attempt, markets rose. Democrats became revitalized, markets rose. What's the difference? Likewise, interest rates haven't really budged much, and certainly not what one would have expected if the markets really believed that these election promises were going to be kept. So are there risks, of course, to a kind of this benign view? We know there are. In my opinion, is the greatest risk is a one-party sweep and implementation of the market unfriendly policies being espoused by both sides. I think I have to be foolish to really try to predict what was going to happen on the political front. But here I go. It does seem like a one-party sweep is not the most likely outcome, and that maybe we don't have to fear a full implementation of either side's policy, which is usually the best way to go. And I think certainly in this case, from the economic perspective, I always have to keep throwing that out there. So and then I have the fourth issue for concern. And this one, maybe I should have ranked third because it's the level of the stock market. So again, thinking about, well, what does the market have in store for us over the next year? Honestly, for me, this is the biggest cause for concern because the stock market's expensive, and it's actually very expensive. So rationally, one might think with corporate profits at historically high levels, which they are, well beyond what's normally achievable in a free market economy, that investors would be cautious about projecting the future. And in fact, it's actually quite the reverse. Expectations about future profits are extremely high. This off of where we are currently, which is already extremely high. And not to try to predict anything, but honestly, the level of optimism that's in the market are at levels that have preceded market crashes in the past. I think we all know it's the tech sector that's carrying the lofty expectations. And certainly our large tech companies are fantastic. They're making huge profits. And certainly AI is a major breakthrough and will eventually change everything. And probably. But not today, not yet. And should the market scale back its expectations for the impact of AI, those lofty tech stock valuations are at risk. And since the overall market has become more and more dominated by the magnificent 7 tech stocks and some others, the entire market actually is at risk from that potential re-rating, a change in psychology about future growth. There is risk there. Of course, just like I picked on some causes of concern for the positives, I can give a cause for positive about this. You know, this time things could be different. The market could be right. The hype hysteria about some of the technology, it could be proven out. But in the meantime, you know, at the family firm, our investments, we're going to tread a little carefully around this area and continue to try to find pockets in the global markets where people are getting a better value and are less dependent on, I'm just going to say it, bubble type valuations. Okay, so back to my list of concerns or optimistic things. Then we have the Fed, where if you follow anything in the mainstream media, it's always number 1, 2, and 3. But for us, it's down the list. There are the usual concerns. Anything about the Fed? Will they cut rates too much, too little, just right? What if they don't cut at all? And I'm just going to be honest and contrarian here. Most of what they do when we're not in a crisis situation, most of what the Fed does has a lot less tangible impact on the economy than is commonly acknowledged. You know, the economy has proven to be extremely resilient during this period of high interest rates. Things have been just fine. And there's really just no reason to wring our hands about the correct level the Fed is targeting, if it's 1/4 point too high or too low. It's fine. It really doesn't impact things on the ground that much. The risk is that the market overreacts to whatever the Fed says or does. And that can, you know, provoke these big swings up or down that aren't really justified by what's going on in the real world. I just have to be honest, unfortunately, investors in the business media obsess so much over the Fed that every utterance can move the markets despite that limited tangible impact. And, you know, that can swing our portfolios around in ways I wish they wouldn't. But it's, in the end, they're not really changing the true economy that much. And I actually take comfort from that. And then, of course, although I said the time frame of 9 to 12 months, but let me just mention all the rest, which are kind of long-term issues that, that are vitally important, but don't really seem likely to impact us on this short term. This is where things fit in, like the budget deficit, international conflicts, nationalism, lack of global leadership, global inaction on important issues like AI regulation, climate change, nuclear proliferation, pandemics. Ugh, it's tough. But there is, of course, a long-term issue that's vitally important. And the ultimate cause for long-term optimism is just the continuous advance of technologies that make the economy more efficient, make companies successful, and just take things in directions that we can't foresee right now. So to summarize, before, I always look forward to hearing what people are thinking, but summarize from this side, again, the economy is fine. We're in a sweet spot. Our dominant companies continue to shine. Just the main concern is that those dominant companies are carrying very high prices, very high valuation that reflect a ton of optimism. And that's a risk that something will puncture that optimism. So with that, I'd always love to hear what you're thinking, and if you have any questions or anything I can elaborate on, I'm thrilled to do it.
And for anyone who has a question, you can unmute yourself at the bottom left on the little microphone, or if you're calling in, you can push *6. And then also remind you, if you want to even type in your question, you can do that. There's a message box.
Yeah, hi, Nate. This is Doug.
Hey, Doug.
Hey, quick question. To me, just listening to the outlines of what you had to say, it sounded relatively optimistic. Inflation, not a major concern. Recession, not a major concern. Of course, those are the two big threats to our holdings. But looking out over the next 9 to 12 months, what are the indications or events that might cause you to revise your estimate or see things a little less optimistically?
Great question. Thank you.
Well, perhaps the election can shake things up. I mean, either way, if we have a situation where all of a sudden we're going to decrease our labor force via expulsions and impose huge tariffs on every trading partner, that's going to make the outlook for inflation much less benign, and will probably prompt a recession at the same time. So, hopefully we can see that coming ahead of time. I don't know. I mean, the experience from 8 years ago is that those promises really weren't kept, thank God, to that degree. But that would be, should they really occur this time, that would really, in my opinion, necessitate a change in what we're thinking. And I could say the same about the other side too, that really, if it becomes a widespread policy, which I know is already kind of being walked back a little bit, but to try to regulate prices and determine prices in grocery stores and what landlords can charge, and every business is being called greedy, that's a bad environment. And I really hope that we don't go down that path either. But that's also a scary one, and I'm not really sure exactly, to tell you the truth, how that would shake out. But a lot of these, it wouldn't be good. And it would probably imply a lot less investor optimism involving capitalism. And just, you could see taxes and increased regulation, that perhaps would be onerous and things like that might depress the level of the market. Again, it's hard to, as we're sitting here now, it's hard to imagine either of those two scenarios playing out fully. But, we definitely have to keep our eyes open, and not just because, the market, as I said, Doug and everybody else, right now, everyone seems very blasé about it, that, it's, these things won't really happen. Don't worry. or we'll end up with a divided government and that will moderate everything. That isn't not a guarantee.
Yeah, we
And
don't
the
know. We don't know.
Yeah, I remember, and I get reminded occasionally that in February of 2020, I was a little blasé about COVID, and I used kind of the same argument that, oh, the market doesn't really seem to be very worried about it, so why should we? And that was pretty dumb.
Well, and then COVID, Nate, is on the rise again. So that
Yeah,
could
well,
also be, that could also be a consideration, you know, in terms of our view of this, right?
oh yeah. I mean, should there really become a deadly variant, or we have something like that again?
Yeah, they just announced, the FDA just announced another vaccine. You know,
Yeah,
what's going on right now, but there's a resurgence of it, so.
yeah. Well, we'd have to see how that would play out, because we'll never have lockdowns again, so that won't
Right,
be happening. So we'll just have to see what
Right.
that means for society.
right.
But thanks for that. Yeah, I appreciate that.
Hey, Nate, if I could ask one follow-up, it's Doug again.
Mhm.
If I detected any concern or maybe pessimism in your voice, it was about a price bubble that relates to tech stocks, which dominate the market right now. And
Yeah,
for all of us who are the family firm's clients, when you have that kind of concern, does it affect the way you uh, handle our portfolios, or is it a shorter term issue that doesn't affect the long-term management of portfolios?
yeah. Well, thanks, Doug. I'm going to be honest here. And, I felt this way for a year or two now. And so if we look through the portfolios, most people would be a little bit light on just a pure S&P 500 index fund, which is so dominated by tech stocks. And that's hindered the returns over a couple of years, because, these companies, their stock prices keep going up in excess of their profit growth. So we've been lagging behind in some cases because of that conservatism. But really, I think how we're trying to reflect it in what we're doing is to emphasize those parts of the market, which sometimes are just called value or mid caps or small caps and things like that. The medical sector of the economy, which has kind of been left, all these sectors that have been left behind in the rush to NVIDIA and Tesla and Apple, and just to try to overweight those. And I hope that the market doesn't come down. I hope that the Magnificent Seven continues to ride into the future. We'll all be fine. We'll all make money. But should the bottom fall out of some of those stocks, I feel good that we're more heavily oriented towards the other parts of the investing landscape. I know it hasn't worked, if you will, but I do feel like I know our clients pretty well. I know you, Doug. I know everybody really on the call, and most people would rather avoid a 10% decline than try to gain, an extra few percent. And that's really what we're trying to do here. Is no one's saying that we're going to have a 2000 collapse like 80% in the Nasdaq. No one's saying anything like that. But if we can tread carefully in those parts of the market that are so expensively valued, it will pay off when bad times occur, which is honestly, it's inevitable in capitalism.
Great. Thank you, Nate.
Thank you.
Sure, Doug.
Yeah, I thank you for your frankness and honesty in terms of what we can expect. Thank you.
Oh, thanks a lot. I wish I knew exactly when it was going to occur.
We don't know. But
Yeah.
I feel like we're in good hands in terms of protecting our portfolios. So thank you.
No, thanks so much. And it is, I mean, I don't want to blow it out of proportion when things went down for one day, because obviously that was just nothing. That was just an ephemeral event. But that was one of the things I'm concerned about, because it's all of a sudden these valuations just come down by 4% in a day for no reason. There was nothing going on. And it's just kind of scary that things could jump around that much. And that just, to me, that just shows that sometimes if a decline does hit, how fast it can occur. We're not going to have time to, now is the time we should sell our NVIDIA. Like, it's too late. It happens too fast. The market psychology happens so fast. So we're just trying to be positioned reasonably and conservatively ahead of time. And then we'll just, we'll all just see how things play out. And I wasn't picking on NVIDIA to say they're ridiculous or anything like that. And as long as sales double every year, its price is completely justified.
Hey, Nate, I promise this is my last question, but in
It's
your
okay.
remarks, you mentioned looking at opportunities around the globe. And earlier in your response, you highlighted some of the opportunities or potential opportunities in the US markets. But as you look around the globe, where are those opportunities outside the US?
Yeah, well, I still think even though it's hasn't paid off because, well, they've got geopolitical concerns and all of that, but just you really need, as investors, we do need to be cognizant that technology does drive things over the long run. And that just leads you to Asia and away from Europe. And again, I know obviously the geopolitical risks around Taiwan and South Korea, they're all there. We can see them. But that's reflected in their prices, and they're just so much less expensive than the American companies that are trying to do the same thing. Taiwan Semiconductor shouldn't be 1/3 the price of an American semiconductor maker. It just shouldn't, but it is. And I don't know if those, again, I probably said this last year, the year before, I've lost count. But at some point, those valuations will come closer together, whether it's just people getting a little bit more confident in the other parts of the world or a little bit less sure of the US leadership. And then, those other investments will pay off more. And we'll continue to be oriented towards those parts of the world besides the US that are growing faster and offer a better value. I don't know exactly when it's going to turn around. Obviously, with mainland China, that's not looking too good, and we have reduced exposure to that. Probably too late, but that doesn't negate from what's going on, and again, in Korea and Singapore and Taiwan, and even some of the smaller areas like Philippines or Vietnam or Indonesia, which are being run pretty competently and developing and exploiting technology well. Well, this has been great, and I really appreciate Doug and, of course, everybody else. Steve will let everybody know. We put it up on the website. We send out the recording to everyone. Anyone that's wants to follow me on LinkedIn is welcome to do it. I put out a couple of things a week, fairly short, little snappy comments, or try to find feuds with people where I can.
Thank you very much, Nate.
Thank you. Terrific. Thank you so much.
Thanks, everybody. Take care.
Very helpful and informative. Thank you so much.